Trading is one of the most competitive businesses that exists in the world today. As a retail trader, you need to be completely aware of how people in this business are incentivized to make sure that you never win. This is level 2, understanding the game conflicts of interest. Conflicts of interest exist in almost all aspects of the business of trading, particularly when it comes to retail traders. In order to understand conflicts of interest in trading, you simply need to follow the money. When you follow the money, you realize where the true incentives are. In order to accurately identify where the conflicts of interest are, you need to first understand who are the actual players in the game of trading, starting with retail traders, passive investors. These are typically regular people that trade from their own funded accounts through a retail broker. They have a retail brokerage account, allows them execution in the live market. Their profit source is personal returns from trading and investments. Pretty cut and dry. The next participant in this ecosystem is retail brokers and introducing brokers. These are marketing entities that specifically target and solicit regular individuals to get involved in the market and deposit funds or deposit margin into their accounts. Their profit source is mostly commission-based profits and some A-book profits for lesser regulated brokers and IBs, which we're going to get into in a little bit. That's a big profit source. Investment banks and market makers. These ones are kind of tied together. Investment banks are the entities that provide a line of credit to retail brokers to supply leverage for live market execution. This is for all their clients. The retail broker typically put up $30 to $50 million to secure $250 million line of credit for leverage extended to their clients, the retail traders. Their profit source is mostly based on collecting annualized interest from credit lines extended to brokers and other entities. They also have profits from market making activities. That leads us to the market makers. Market makers provide liquidity and trade matching services to brokers, hedge funds, and other organizations that execute trades. Their profit source is profits from spread between the bid and the ask price and profits from proprietary trading activity. And our last entity we're going to talk about is interbank brokers. These guys are the big boys on the block. They provide liquidity to world banks, market makers, and institutions to facilitate large, and I mean really large, international transactions, particularly in Forex. Their profit source is profits from spread between the bid and the ask, just like market makers, and they also profit from proprietary trading activity. And if you look to the right and reference my triangle of ultimate power, we have the central banks and private entities. We all know what central banks are. That's like the Federal Reserve here in the United States. But what you may or may not know is that the Federal Reserve is not a government entity. It's actually privately owned and operated. By who? Private entities. You can only guess who those people are. Every single one of these levels is pretty much controlled and answers to the level above. For all of you retail traders watching this presentation, here's another insider secret you need to be aware of. It's called the 90-90-90 rule. Basically, this states that 90% of traders will lose 90% of their account within 90 days. This is an industry-wide standard metric among brokers. They can count on these numbers. Out of every 9 out of 10 people that deposit margin into their account, 90% of that will be gone within 90 days. Because of the consistency of this metric, they have created a product just for you guys. It's called Contracts for Difference, or CFDs. So CFDs allow you to trade stocks, indices, crypto, precious metals, all through your brokerage account with extremely high leverage, usually 100 to 1 or 500 to 1, and sometimes more leverage you get on these products. Now, the key thing to understand is that you do not actually own the underlying asset. Okay? Very key to understand that. You are in a contract with your broker for the difference in the trade. So whether you win or lose, they will either deduct or add the difference in balance to your account. These instruments are primarily used for OTC gain. What is OTC gain? We're going to get into that. Very important to understand this stuff. So now that you know what a CFD contract is, let's talk more about retail brokers' revenue streams. There's 4 main revenue streams of the broker that you need to know about. Number 1, you probably already know this one, is the spread. That's the markup on the market maker spread between the bid and the ask. The broker is going to add typically a little bit to that so that they can make an override. The next one is going to be commissions for processing trades. Some brokers ask for commissions, some don't. That's where there's just a flat fee that they charge when you get into a trade and sometimes when you get out of a trade too. The next one is finance turn. The broker is giving you leverage to amplify your buying power on your margin. That's why you deposit the margin to your account. They may charge you daily interest on that. As you notice, if it goes from one day to the next, sometimes there's a slight charge on carrying that trade over. That's what that is, finance term. The next one is the big one that you really need to be aware of, which we brought up earlier, is the OTC gain, taking the other side of clients' trades via CFD contracts. This is an important one. So conflicts of interest with retail brokers. The retail broker provides on-demand liquidity to the retail trader and typically a trading platform and data also. What you need to know is that that is pretty much where the majority of the broker's value to the retail trader stops. They are giving you a lot though. They're giving you a platform to access the market. They're giving you market data. They're probably giving you a pretty nice trading platform. All good, great things to take advantage. But where are the incentives according to their revenue streams? So in order to really maximize their first three revenue streams, being spread, commissions, and finance turn, their incentives are for you to trade as many times as possible in the biggest size as possible. Basically, trade volume and frequency. So what does volume and frequency mean for the broker's OTC gain? Well, quite a bit. If you're trading very frequently at very big position sizes using all that leverage that they've given you, so very tempting, trying to maximize every little trade that you take, well, you have an almost certain chance of losing all of your margin that you deposited into that brokerage account. And guess what? It's going to go right into that broker's pocket. This is by far their biggest revenue stream. So just think for a second about brokers who advertise zero commissions, instant execution, low spreads. Where would their main profit source be in this revenue stream model? Well, if they're not getting commissions, it's not there. If they're offering instant execution, how can they always do that? It's because it's not going to the live market. They don't need to fill anything. They're just taking it in-house. Instant execution, it's like a demo account. And if they're offering low spreads, well, there's not a whole lot of money there as well. Their main profit source is an OTC gain, meaning how much money can I get you to deposit into your account because I have a high likelihood of keeping all of it. That's what the broker is thinking. So a few more things that you need to understand about the OTC gain model for the brokers is the following. The broker operates with two different books of business. We call it the A book business and the B book business. In the A book of business, that's where they keep all their losing traders. On the other side, we have B book business. This is where they place their winning traders, about 5%. So how does the A book business work? The OTC process is that all trades made by an A book trader, an A book classified trader, are kept in-house. There's no extra hedge on the broker's end to consider for losses. So they're basically trading naked, taking the other side of this A book losing traders' positions. The result is that the broker makes spread, commission, finance turn, and the complete OTC gain from the trader's losses. So the client loses full trade difference in the A book of business. So for the B book of business, it's a little bit different. In this process, all trades are still kept in-house, but the difference is that when a B book trader executes a trade, it is immediately going to be hedged with the real underlying asset for the broker so that they don't actually lose money because it's a winning trader, right? So the result of this, the broker makes a spread, they make the commission, they make the finance turn, but they do not make the OTC gain, which is the piece that they really want to make. So the client will make the full trade difference because they are a winning trader. Now these traders don't really hurt the brokerage, but they're annoying. They tie up resources and they tie up the funds that are extended to the broker from the investment bank. So overall, you could see which type of client is the broker really incentivized to get. A book business clients or B book business clients. You'd be the judge of that. Now let's talk about introducing brokers' revenue streams. So what is an introducing broker, first of all, so you're perfectly clear? An introducing broker is pretty much anybody who recommends that you join a specific brokerage or deposit into an account. You can think of all your influencers on YouTube, all the people on the internet. Are they or are they not asking you to join a specific broker? If they are telling you that you got to get with this broker, chances are they are an introducing broker and they are incentivized because they get a percentage of these four revenue streams that the broker gets. They're going to get a piece of the spread, they're going to get a piece of the commission, they're also going to get a piece of the finance turn, and they may be getting a piece of the OTC gain as well, depending on the broker. So what are the conflicts of interest? Well, first thing you got to understand is that most online educators in the trading space are also introducing brokers. So you need to look out for this. If they are teaching you a strategy on one hand and then telling you that you need to sign up with this broker on the other hand, keep in mind that they have incentives aligned with the broker's revenue streams. The strategy that they're teaching you is probably one of volume and frequency because they're getting paid by the broker. Keep that in mind. So IBs are the sales force of the retail broker. They're helping the retail broker onboard new clients so that they could make that 90-90-90 rule work for them, get that OTC gain. So the goal of the IB is to persuade you to deposit as much as possible, trade as frequently as possible, in the biggest size as possible because they're sharing in the same revenue streams as a broker. Most will use just about any tactic to lure you into the trader's lifestyle dream. Now, I'm not here to call anyone out, but I've been in this business a long time, over 12 years. I've literally worked with thousands of people, and I have yet to see an actually good trader trade from their phone while driving a Lamborghini, driving to their private jet. Number one, real traders don't use their phone to trade. Number two, real traders don't flash their stuff. They typically live a more quiet lifestyle. So again, not trying to call anyone out, but you need to be aware of these marketing schemes because they're trying to get you in typically to use their broker and a lot of their services and things to lure you into that. Beware of these things. If it looks too fantastic, it probably is. And the new hack for some of these influencers and introducing brokers is to actually go as far as opening their own brokerage. This way, they get to capitalize on all four of the revenue streams, but they also get to create false accounts that say they're real. They simply type in this is a real account, but it's actually not. That way they can show you huge profits that are completely unrealistic, especially for the normal person, lure you into their brokerage and really take advantage of all those revenue streams as you lose your hard-earned money. So make sure you're aware of all these things. Don't be naive. Understand how the business works. So that covers the main conflicts of interest that you need to be aware of when it comes to the marketing of the trading business. But now we need to be aware of the conflicts of interest that exist in the actual trading part, the part where you get in and out of the market and either win or lose. So now we're going to talk about the market makers' revenue streams. So the market maker is actually pretty straightforward. They make money from marking up spread, so that the distance between the bid and the ask, and they also make money from proprietary trading, which is actually just trading their own account and making profits the same as you would. So when it comes to conflicts of interest with the market makers, there's a few things that you need to be aware of. Number one, all the orders that actually make it to the live market are processed by a market maker. So this gives market makers an unparalleled depth and insight into the real liquidity of the market, what traders are actually doing, and where the liquidity is to be able to get in and out of proprietary trading positions, which if you're trading a large size, you definitely want to know that if you push price a certain level, there's going to be liquidity there that comes into the market to fill your position. So very important information that the market makers have because of the nature of the business they do. Market makers also trade their own account. So they're able to take that information and use it to monetize for proprietary trading positions. Market makers also control the flow of the supply in the market. They are the gates of supply. And whoever controls the supply ultimately can control the market to a certain degree. And that's usually enough degree that they could manipulate it. So this means that they could temporarily suppress or inflate prices at will to a degree. So let's briefly look at an example of how market makers can manipulate the market. Just in brief review, market makers take on the responsibility of matching willing buyers and sellers. That's their main job. All orders placed and pending are sent to a market maker for execution. The information market makers get from processing everyone's orders gives them a level and depth of insight into market liquidity and intent that others do not have. So this example is going to show us both of the market makers' revenue streams in action and typically how it plays out. So with this section of market, we can see this is the contraction phase that we talk about in the master pattern methodology. In this phase, market makers focus on efficiently matching buyers with sellers in a sideways market. They're collecting a lot of spread. Anytime you have a lot of willing buyers and willing sellers at the same time, the market maker is collecting spread on both sides while keeping the market compressed in a controlled range. But eventually, it's going to break out of that range like we see here. So when we finally break, then price breaks out long, buyer sentiment is revealed to the market makers, more buyers rush in. What happens when a bunch of buyers rush into the market? Well, they're going to want to protect themselves. And how do they protect themselves? They place their stop losses, right? So we see that down here below the low of the box is a great place for all the breakout traders to put their stop loss, because if it goes to that level, they're going to feel highly uncomfortable, right? It's that whole pain and pleasure concept coming back into play. So what do the market makers do? Well, they've already gotten all of their spread from the efficient market, that sideways market. Now the market's becoming inefficient. Now it's time for proprietary trading. So they drive the price down to the stop loss level, which is going to trigger a very predictable pain response from traders, creating what? Creating liquidity. And if those are sell stops, getting traders out of their buy positions, what's the other side of a sell stop? It is a buying opportunity. So the market makers drive price down to buy up those sales stops with their own trading account. So now they're getting that prop trading revenue stream going. And then they know that the ultimate sentiment in the market is flowing to the upside. So very easy. They cut supply in the market goes up. Market makers take sell pressure off price. Up move resumes as originally intended. Traders jump back in long. Market makers take profits. So as traders start rushing into that up move, probably the same traders that just lost, that just got stopped out, they jump back in, creating that buying demand, and then the market maker distributes those proprietary positions for profit. So this is a model of how those two revenue streams work, and this is really the model of the master pattern. So what's the takeaway from this lesson? Well, brokers and market makers are a necessary evil. We cannot do what we do and have the access that we have as retail traders without their services. But as a retail trader, you need to be aware of the tricks and the snares used by brokers and market makers so that you don't fall victim to those tricks. You need to choose your broker wisely and make stability and regulation a large factor in your decision when choosing a broker. And you need to be aware of how the market makers do business. Watch for their activity and operate outside of their grasps. And that all comes down to understanding the master pattern model. So now that you understand how everyone is incentivized in this business, you can use this information to decide who you want to listen to as a trading educator, the brokers that you want to use, and the strategies that you want to use as a trader to make sure that the odds are tipped in your favor.